Good morning, and welcome to today's webcast, Prepare Your Business for California Climate Disclosures. Before we begin, I'm going to play a brief housekeeping video.
Welcome and thanks for joining us. Our webcasts are designed to help elevate your business performance. Transform your future for the better with advisory solutions tailored to your vision and supported by our collective technical resources. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget. You can ask our presenter questions during the webcast by typing a question in the Q&A window and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% or 3 of the 4 polling questions, which we'll ask throughout today's presentation. Polling questions will appear within the slide window. To participate in the polls, please click on your answer and be sure to hit the Submit button to record your response. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry, if you can't download your CPE certificate today, we'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our group CPE attendance sheet to receive credit. The attendance sheet is available in our slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit only can be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And then briefly before we get started, I wanted to share our big news that Moss Adams and Baker Tilly have joined forces to redefine accounting, tax, and advisory services for the middle market. It's really exciting, and you could read more about it on our website via the link in the slide deck and handouts widget. And then with that, I will turn it over to Debbie to get us started.
All right, thank you, Emily. And thank you, everybody, for joining us today. So good morning, good afternoon. I am Debbie Biddle-Castillo. I am a principal based out of Southern California. I am Baker Tilly's ESG advisory leader, and so spend a lot of my time supporting companies on how to build out compliant, pragmatic, well-controlled reporting processes. So very happy to speak to you all today about sort of the California Climate Act, and I will just echo what came up in that video. Please do put questions in the Q&A. We will be monitoring throughout, and we'll do our very best to answer as we go through. All right, over to you, Madison.
Thanks, Debbie. Hi, everyone. Really excited to be here today. My name is Madison Poitras. I'm an ESG Senior Manager, part of Baker Tilly's consulting group within our strategy and operations practice. I've been in the climate sustainability space for over 10 years now. My background has really been focused in ESG within a variety of industries related to ESG regulatory compliance, reporting with ESG frameworks, internal controls over ESG data, and overall ESG strategy. So Debbie and I are really excited to get started and talk through these California climate bills. Back to you, Debbie.
Thanks, Madison. Okay, so let's just kick off quickly with learning objectives. So today we are going to be learning about the scope, applicability, and status of the climate disclosure laws, so which companies need to report under these new laws, understand timelines and reporting requirements related to SB 253, 261, and 219, and we will be talking about sort of the companies are covered, what data must be disclosed, and assurance requirements that are behind these laws. So before we kick off too much into the content, we are going to start with our first polling question. So Emily, over to you.
All right, thank you. Our first polling question today: what brings you to today's session? And your options are A, passionate about all things ESG, B, need help with California Climate Bill SB 253, C, need help with California Climate Bill 261, or D, multiple of the above. So I'll give everyone a few moments to respond. To participate in our polls, please click the button next to the answer you choose and hit submit. And if you're having any difficulty seeing the polls, you could refresh your browser with F5. I'll give everyone just a couple more seconds here. All right, let's go ahead and take a look at the results. Back to you.
Great, thanks, Emily. Okay, so for today, our first section will be focused on the high-level definitions of these California climate bills and really just setting the stage before taking a deep dive into each bill. So getting started here, and I see everyone is already putting questions in the Q&A, and I promise we will try to get through all of those, and I'll touch on those as we kind of go through each bill. So as I'm seeing questions in the QA related to SB 261, I'll address those, and then Debbie will address SB 253 ones. But yeah, so this slide here is just an overview between these three bills. Overall, you can think of these bills as a way to encourage companies to really report their greenhouse gas emissions and climate-related financial risks. So starting with that SB 253, also known as the Climate Corporate Data Accountability Act, this bill really does focus on greenhouse gas emissions data. SB 261, also known as the Climate-Related Financial Risk Act, focuses on financial risks and opportunities from climate. And really, SB 219 is a supporting bill that helps clarify and adjust rules in SB 253 and SB 261. So starting with this, prior to jumping into each bill here, we did want to provide and represent the broader regulatory and voluntary reporting landscape around these climate disclosure laws. So first, I think it's really important to note that California is now the first state in the United States to require companies to report their Scope 1, Scope 2, and then later on Scope 3 greenhouse gas emissions, along with climate-related financial risk. So this really sets a clear regulatory precedent that is influencing policy in other states. So we are already seeing similar bills being proposed in multiple other states, including New York, New Jersey, Illinois, Washington, and Colorado during these 2025 legislative sessions. These other states are following California's approach, including reporting thresholds very closely, which presumably means that reports prepared to comply with California law can be easily modified for submittal to other states as those laws are brought into action. So we did want to note we are seeing this state activity growing. Next, we are really seeing investors and financial markets demanding transparent and comparable climate-related disclosures to assess risks and opportunities. So compliance with these laws enhance that corporate credibility and access to capital, meeting those investor and market expectations. So outside of compliance, we do see that investor request and need. In addition, these climate laws do support California's existing climate policies, so specifically their goals for 2030 emission reductions and reaching carbon neutrality by 2045. It introduces a mechanism for California to track progress at this entity level. And then these laws do require companies to report their emissions and climate risks using standardized frameworks like TCFD, like the Greenhouse Gas Protocol that we'll go through today. So this does kind of help establish consistency in that data that gets reported and publishes and are used by those various stakeholders, including investors that I mentioned earlier. So it really helps make strong business decisions and provides transparency. So as ESG regulations or climate regulations continue to evolve globally, these requirements do set a tone for companies operating in California to be aligned with, recognized and industry accepted reporting standards. So overall, you can think of these bills that present a start of a movement that other states are trying to follow, but also represent that larger phenomenon of voluntary reporting, which companies are feeling the need to tie their financial performance to climate and environmental risks. And then we wanted to take some time today to provide some legislative background, history, and status. So walking through these key phases here of how California's climate disclosure regulations are being developed by CARB under the Administrative Procedure Act, or APA. So we'll start with that first phase, which is initiation and drafting of the regulation. So CARB began the regulatory process in late 2023 after SB 253 and SB 261 were signed into law. This stage was focused on internal coordination, identifying key regulatory topics, and drafting early rulemaking language consistent with APA requirements. This part is now complete. And next is the pre-rulemaking engagement, which is still ongoing. So throughout 2024 and now continuing into 2025, CARB, as many of you know, has held public workshops to gather stakeholder input. These discussions have really focused on things like definitions, emission calculation methodologies, and the structure and timing of assurance and reporting requirements. So as of August, last month, CARB has not yet issued the official notice of proposed action, which means the formal 45-day public comment period has not yet started. That step is required by the APA and will mark the next official milestone in the rulemaking process. Once that comment period ends, CARB will enter a final deliberation phase. So reviewing public input, finalizing the language, and then submitting the package to the Office of Administrative Law, or OAL. That OAL will then have 30 days to complete its legal review before the rule can be approved and filed. So per this APA timeline, this entire process from the issuance of the notice of proposed action to final filing must be completed within 1 year. So you can see this visually at the bottom of this slide. The timeline runs from late 2023 to we're now into mid 2025 with clear sequencing between public engagement, the comment window, OAL review, and final filing. So based on the latest CARB workshop that took place on August 21st, CARB now plans to issue draft regulations in mid-October, covering at least scoping and fees, which will be open for a public comment until November 30th, and then regulations will be finalized in December. And with that, I will pass it over to Debbie.
Thanks, Madison. Accountability Act, which is the one that requires companies with more than 1 billion total annual revenue doing business in California to report greenhouse gas emissions annually starting in 2026 based on 2025 data. And as Madison just mentioned, right, these bills are not yet finalized, and there are some key definitions which remain under review, but because of the timeline of when we need to start complying, we still need to move along the path of preparing. And so what we'll be talking about today is what we do know, what is still pending, and the latest guidance that CARB has shared with us sort of directionally. So as Madison mentioned, CARB has held 2 workshops. And so what they have done in those workshops is share proposals for some of the pending areas and soliciting feedback, which directionally gives us guidance about where they're going. So we'll be sharing that feedback today. So getting into the detail, the WHO, and unfortunately, the WHO is an area where we do still have some pending questions. So companies with greater than 1 billion in revenue, and I do want to emphasize that is not just California-based revenue, sort of that's overarching revenue for your organization, but that does business in California. The 2 pieces that are still under sort of definition is What do we mean by revenue? And what does it mean to be doing business in California? We have some slides later on where we're going to sort of really dig into the latest updates. And so I'm going to save some of that for later on. But I will sort of just say for revenue, the latest guidance that we've got out there is a proposal that revenue is the total global amount of money or sales a company receives from its business activities, such as selling products or services, and does not deduct operating costs or other expenses. And applicability here is based on revenue for the prior fiscal year. So what is required? It is required to report Scope 1 and Scope 2 greenhouse gas emissions beginning in 2026 for the prior fiscal year. So your first year of reporting, if you meet sort of the thresholds for the WHO, is going to be in 2026 based on this year's Scope 1 and Scope 2 data. CARB has proposed a deadline of June 30th, 2026 for that reporting to be finalized, disclosed, and that has to include your limited assurance opinion at that point. So that doesn't give sort of all that much time in the start of next year to go through sort of all of your data collection and your assurance, but that's the date that is currently being discussed. Then we do move into reporting of Scope 3 emissions beginning in 2027. So we don't want to lose sight of that. I am going to talk a bit more about what Scope 1, Scope 2, and Scope 3 are. Obviously, we're focused on Scope 1 and Scope 2 because that is our first year requirements. Scope 3 is tricky and it's going to come up quickly. So let's not lose sight of the fact that that will be coming in 2027. In terms of standards, there is an established reporting standard out there, which is a greenhouse gas accounting protocol, and we've got some links here for you. That is sort of the preeminent protocol that's out there for companies measuring their greenhouse gas emissions. So if you are part of an organization who has been reporting Scope 1, 2, or 3 in prior years, you have very, very likely been reporting under the greenhouse gas accounting protocol, which is fantastic, right? That's what we want to see. We want to see a protocol that is commonly used. And then assurance, limited assurance will be required on Scope 1 and Scope 2 beginning in 2026. So that is your first year of reporting. You're not only reporting, but you're including a limited assurance opinion alongside it. And then reasonable assurance for Scope 1 and Scope 2 is going to be currently anyway phased in 2030, so a little bit of time. Again, I'm going to get into a bit more detail about what those two levels of assurance are and what the differences are for you, so you can think through that. There is not currently requirements for assurance around Scope 3. Now, CARB has indicated for this first year that it is going to exercise some enforcement discretion as long as companies take good faith measures to comply, and that they're going to be considering when those measures were taken, and which makes a lot of sense, right? Because we don't yet have the final regulation and we're all out here trying to prepare. It makes sense that we're not going to sort of be going through full sort of enforcement discretion in this first year. However, subsequent to this first year, non-filing, late filing, or other failure to meet requirements, penalties can be enforced up to $500,000 in any reporting year. And then in terms of location, the requirement is going to be that we publicly disclose on a digital platform. CARB in their last workshop did say that they will be sharing reporting templates for Scope 1 and Scope 2 in the coming weeks. So we'll keep an eye out for those as they come through. So what actually is greenhouse gas emissions, Scope 1, Scope 2, Scope 3? This might be a review for a lot of you, but we want to make sure we're grounding ourselves in sort of the detail. So Scope 1 is all direct greenhouse gas emissions that stem from sources a reporting entity owns or directly controls. So that it can include things like fuel combustion from boilers. If you're a manufacturing company and you own your factories, you're going to have Scope 1. It can also include company-owned vehicles and those emissions, regardless of where those emissions physically occur. Scope 2 relates to all indirect greenhouse gas emissions from consumed electricity, steam, and heating. And so even though the company doesn't produce these emissions directly, they are tied to your company's operations. These are going to be the category that sort of pretty much every organization has, and it's going to be sort of the electricity, gas, etc., that you're purchasing from utility companies. And then Scope 3 is indirect. So indirect emissions, meaning going up and down your value chain. So they occur outside of your direct control, but they are still sort of part of your wider business operations. And so that can include things like emissions related to published goods and purchases, goods and services, business travel, employee commuting, and the use or disposal of sold products. There are sort of 15 defined categories around Scope 3. Like I said, that one is a little tricky because we don't necessarily own the data or have access to the data. And so that is going to take some time to get our arms around if you haven't started down that path. There are greenhouse gas accounting protocol guides out there which are available for everybody to look at and assess. They are made up of sort of, we've got 3 that we've got listed up on the screen here. We have got the corporate standard, which is the core framework that provides companies requirements and guidance for preparing a corporate level greenhouse gas inventory. So it focuses on consistency and comparability using standardized methods. And key objectives include sort of ensuring a true and fair amount of emissions, reducing the burden of reporting through standardization, providing decision useful data for strategy and reduction planning, and increasing transparency across programs and companies. Then we have the Scope 2 guidance, which provides us with more technical clarity for indirect emissions from electricity and energy purchases. So it was introduced to clarify how to account for market-based and location-based emissions, and so plays a really key role in increasing data transparency, particularly around use of renewable energy certificates and power purchase agreements. And then finally on the right, we have the Scope 3 guidance, which is a technical calculation companion for specific to Scope 3. So it goes deeper into how to calculate emissions across those 15 categories that I mentioned, with detailed methods for each category, help with choosing the right calculation approach, and examples to walk through common calculations. So these guides are going to be essential for you for sort of understanding and applying the greenhouse gas accounting protocol as you're looking to comply with SB 253. This is a very, very high level example of the greenhouse gas emissions calculation. So in the simplest way to explain this, we are taking activity data, so our organization operations over here, this 250,000 megawatt hours. So that's our activity data. We are multiplying that by an operations emission factor, and we are getting our total emissions. And so the defined gases that we're concerned about is not just carbon dioxide. So that's where you see the CO2e, which is carbon dioxide equivalents, and it includes a number of defined gases within sort of the protocols of carbon dioxide, methane, nitrous oxide. That's all called out in the accounting protocols. But that gets us to that final number, that total emissions number that we are going to be reporting. So as we think about sort of pulling processes together, internal controls, how we're building what we're doing, there's a couple of different things to be thinking about. The first is, where are all of our greenhouse gas emissions coming from for Scope 1 and Scope 2? And do we have a good sense of that inventory? Is it complete? What is the activity data out there for the 2025 year? And then sort of doing this calculation of applying emission factors then to get to sort of what we're then finally going to report. So assurance. This first year, we are in the limited assurance space. And as you'll recall, I said Scope 1 and Scope 2 is going to be under limited assurance from the 2026 year, so from the year of first reporting, until 2030, when reasonable assurance is due to come back in. But this does not currently apply to Scope 3. So for the review, the limited assurance, the assurance is in sort of the negative. So really it's a statement around like nothing has come to our attention that causes us to believe the emissions data report is not materially correct. Now, CARB has come out and said they're not going to be providing a list of assurance providers or certifying assurance providers. They have identified 4 standards that they've requested feedback on that would be sort of the standards which would be allowable for these to be conducted against. And that is AICPA, the ISO 5000, which is the international standard, ISO 14060, and AA 1000 for public feedback. They have emphasized the importance of independence around your assurance provider. And so you can really think about that in a very similar vein as you think about financial auditing independence. You want somebody that's going to be doing your assurance that hasn't been involved in sort of pulling your data together or doing sort of your calculations for you. Now, when you go through limited assurance, what that is going to feel like for you is your assurance provider is going to want to understand from you the process that you've gone through to identify your greenhouse gas inventory. They're going to want to sort of make sure that they can get comfortable that it's complete. So you'll need to be able to talk through that with them. They will also want to sort of understand the process that you've gone through to collate your data so then they can plan their validation testing. They do not need to do internal control testing under limited assurance, but they will still need to understand sort of what you've gone through in order to sort of feel comfortable in what you're reporting. Then they were wanting to be tying out your numbers. So if I use scope 2, because that's sort of an easy example, if we've got scope 2 that we are reporting, they are going to be wanting to tie back to invoices as much as possible where you have those available, or whatever source documentation that you have that is supporting your reporting. If you are making estimates around your greenhouse gas emissions, they will want to understand the basis of that estimation, how you've done the calculation. They will want to be able to recalculate and see sort of that the math works, and they'll want to be able to make sure that they feel comfortable with the estimation approach. So I lay that out for you because as you think about complying here, you do need to make sure that you are maintaining documentation. So that is source documentation where you have it, like the invoices, or it is documentation around estimations that you are following. Many companies will put inventory management plans in place, so you can think about that as sort of like a policy document around your greenhouse gas emissions, which lays out sort of what emissions do we have, where are they coming from, what's my calculation approach, who's involved in that calculation, and sort of pulling that document together. We highly recommend, because then you've got that available for yourselves for the future, so you can keep track of what you've done, but also then to provide across to your assurance provider to lay out, this is kind of what we've gone through. Now, reasonable assurance, I will just quickly mention because it comes in 2030. It is a higher level of assurance, so it's higher but not absolute, and that they are then needing to affirm the information reported is materially correct. So it's more similar to sort of a financial statement audit. It is very likely under reasonable assurance that internal controls will be part of that assessment. So not necessarily needed from an assurance perspective year one, but something for you all to bear in mind as you're building out your reporting processes. All right, so I'm going to pass over to Emily for the next question here.
All right, thank you. Our second polling question: which framework is suggested for the greenhouse gas emission reporting under SB 253? And your options are A, Global Reporting Initiative, B, Sustainability Accounting Standards Board, C, Greenhouse Gas Protocol, or D, all of the above. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. We're on our second question right now. Give everyone just another moment to make their selection.
Yeah, and while we're waiting on, the polling results to come in, I wanted to quickly answer a couple Q&A questions that have come in. So one of our questions was, how do you get access to the greenhouse gas protocol guides? So these are publicly available. So those guides that Debbie had mentioned, the corporate standards, scope 2 guidance, scope 3 guidance, if you Google, greenhouse gas protocol, standard and guidance, those are publicly available and are very helpful and detailed to help you get more familiar if carbon accounting is a new area for you.
All right, let's go ahead and take a look at our poll results. Back to you.
All right, thanks, Emily. All right, it looks like we have a mixed response here. Greenhouse gas protocol is the correct answer for SB 253. So as I mentioned, those guides are publicly available if anyone has interest, to better understand and do a deep dive into those. But with that, we're gonna switch over to SB 261, which is the California Climate Financial Risk Act. This law does apply to companies with over 500 million in total annual revenue that are doing business in California. I noticed one of the other Q&A questions is the revenue amount. So the bill that Debbie just went through, SB 253, is 1 billion in annual revenue, while SB 261 is 500 million in total revenue. So under SB 261, these companies will need to publicly disclose their climate-related financial risk and mitigation measures. These disclosures must be made every 2 years, starting next year in 2026. This law is intended to align with California's broader climate risk transparency efforts, and it draws heavily from existing international frameworks for risk disclosure, including that TCFD framework, which stands for Task Force on Climate-Related Financial Disclosures, which I will do a deep dive on in just a bit. So unlike SB 253, this focuses on financial risk posed by climate change, while SB 253 is more focused on the greenhouse gas emissions. And with that, we'll get into the required content and reporting format for SB 261. So I mentioned, this is applicable to those entities with 500 million in annual revenue. CARB is still, a gray area on defining what revenue means, but as Debbie mentioned earlier, this is not just revenue in California. More to come on that definition, as I do think CARB has received a lot of feedback related to that revenue definition. This law does include exemptions for insurance companies. I will say, I saw another Q&A question. There were proposed other exemptions from the CARB workshop that took place recently, including non-for-profits, government entities, companies with only business in California with the presence of teleworking employees. Those proposed exemptions aren't final yet, but they were discussed as potential future exemptions for SB 261 and SB 253. So more to come on those other exemptions. So what's required? Covered entities must prepare and publicly release their first climate-related financial risk report by January 1 of 2026. Obviously, that is quickly approaching. The report may include data from fiscal years 2023 to 2024, 2024 to 2025, based on their recently published FAQs and also based on the workshop held by CARB. So depending on your organization's reporting cycle and what information is readily available, we do have some flexibility in what years of data that you are using for your climate-related financial risk report. In terms of the reporting standards, most organizations, I think right now, are relying on that TCFD framework, but there are other standards available and usable, such as the International Sustainability Standards Board, which is the ISSB framework, is also permitted. Penalty enforcement, so a little less compared to SB 253. And again, that good faith effort will come into play here. But as we get past this first year of reporting and the bar gets higher for this type of climate-related financial risk analysis, CARB had mentioned penalties up to $50,000 per year. There were some other questions in the Q&A. CARB did note, scenario analysis is not required for this first year of reporting. A qualitative narrative will suffice and will meet the minimum reporting requirements for SB 261. In addition, they also noted that if you have not already calculated, your scope 1 through 3 greenhouse gas emissions, those do not also need to be included in your SB 261. If you have them, they encourage you to include scenario analysis and your greenhouse gas emissions. But if you do not already have them, they said to meet the minimum reporting requirements, you do not have to develop them before that January 1, 2026 due date. All right, and then we did want to take some time just to, kind of go over just what is climate-related financial risk. Everyone talks about it. This is the basis of this bill. But what does this actually mean? So a climate-related financial risk does refer to any material risk of harm to a company's financial condition or long-term performance that comes from either physical climate impacts or transition-related impacts. So on the left-hand side here, we have our physical risks. So you can think of physical risks broken down into two categories, starting with acute risks and then chronic risks. So acute risks are short-term extreme weather events, wildfires, droughts, or hurricanes, while chronic risks are longer-term changes, such as gradual temperature rise, rising sea levels, or sustained reductions in rainfall. So overall, you can think of these physical risks as direct impacts of climate change that fall into acute or into chronic risks. And then on the right-hand side here, we have transition risks. So you can think of transition risks as a societal shift towards a low-carbon economy. So this can include policy, technology, market dynamics, and consumer preference. So an example of a policy transition risk would be when governments introduce new climate regulations, such as Canada's carbon tax on CO2 emissions, or market dynamics in which customer behavioral, material costs, or market demand are driven by climate considerations. So when you think about creating your climate-related financial risk report for SB 261, your framing of risks are broken down into these physical and transition risks. All right, these are the 4 main core elements of this TCFD framework. So this is what the structure, if you are using the TCFD framework, will look like for your climate-related financial risk report. So these 4 core elements are interrelated and supported by 11 recommended disclosures that fall under these 4 pillars. This information is intended to help investors and other stakeholders truly understand how your reporting organization thinks about and assesses climate-related risks as well as climate-related opportunities. So this visual here is supposed to show you those 4 core components with governance, strategy, risk management, metrics, and targets. So for our time today, because we don't have too much time, we are going to focus on climate risk. But I do want to note that it is important. An important key element of this framework is also that consistent categorization of your opportunities. So climate-related opportunities will vary depending on your region, your market, your industry, but you also need to consider the opportunities, including like resource efficiency, energy source, products and services, and how that also plays a role alongside your climate-related risks. All right, and with that, we're going to our next polling question. Emily, over to you.
All right, our third polling question: what is the revenue threshold for companies subject to SB 261, climate-related financial risk disclosure? And your options are A, $100 million, B, $500 million, C, $1 billion, or D, none of the above. And for those of you that would like a copy of today's slide deck, you can download them from the folder that says slide deck and handouts. We'll also be sending the slides via email after the webcast. I'll give everyone just a moment to respond here.
Yeah, and while everyone is responding, wanted to hit on one more of the Q&A questions. We're getting a lot of questions, and I think the whole market is asking this question between parent, subsidiary, holding company levels of reporting. So CARB in their workshop, their most recent workshop, did note that these laws are intended to be at the reporting entity level. So if you have a subsidiary that are meeting those revenue thresholds, these laws are intended for them. SB 219 does allow you to report at the parent company level, and you may do that, but really the laws are intended for the reporting entities meeting those revenue thresholds. Obviously, there are a ton of gray areas, a ton of nuances with how organizations are structured. So CARB did mention they are going to provide a lot more feedback on what is required, what is accessible based on those more complex reporting structures. So I would say if you have a really complex reporting structure with many subsidiaries, many holding companies, more to come, and CARB does, I think, acknowledge they need to provide more clarity in this area. All right, sorry, Emily, go ahead.
Oh, no, that was great. Thank you. And we'll go ahead and take a look at the results. And back to you.
All right, everyone has had their coffee or their iced coffee for the afternoon with the correct polling question or correct answer of 500 million. And with that, we're going to jump into these 4 core components again. So we're starting with that recommend disclosure for governance of the TCFD framework. I showed a couple of slides back. So how does the organization actually provide governance around climate-related risks and opportunities? So these 2 bullet points on this slide here includes 1, describing the board's oversight of climate-related risks and opportunity. So examples of this would include disclosing processes and frequency in which the board or board committees are informed about climate-related risks. Whether the board considers climate-related risk issues in guiding strategy and major plans of action, and how the board monitors and oversees progress against goals and targets for addressing climate-related issues. And then that second bullet point in the same vein describes management's role in assessing and managing climate-related risks and opportunity. So an example of this would include how the organization has assigned climate-related responsibilities to different management level positions within your organization or committees. And then also how management is informed about those climate-related issues and how management escalates those specific climate-related issues to the board level or the oversight level. So really, you can think of governance as how are we, accounting for understanding these climate-related risks within your organization. Moving to that second pillar of the TCFD framework strategy, this includes disclosure of the actual and potential impacts of climate-related risks and opportunity on the organization's business, strategy, and financial planning, where such information is material. So for these 3 bullet points here, we have, you're describing climate-related risks and opportunities the organization has identified over the short, medium, and long term. So you'll want to make sure in your report you note what short, medium, and long term are based on what those risks are. For that second bullet point, you want to understand and describe that impact of climate-related risks and opportunity on business strategy, financial planning. Examples of this second bullet point here would be describing, for example, the impacts on products and services, supply chain or value chain, investment in R&D, so anything within your strategy realm. And then that third bullet point there is related, that I talked about a little bit earlier about that climate-related scenario and how we can do now a qualitative narrative versus a quantitative scenario analysis based on CARB's most recent update. And then our third component is risk management. So you can think of this as how does your entity identify, assess, and manage these climate-related risks. So, these 3 bullet points is really identifying and assessing those climate-related risks on significance of climate-related risk in relation to other risks. If you have a second line function, your enterprise risk management function, how are these climate-related risks included in your audit universe? Any of your risk management, processes or groups that you have in place, now it's adding in this layer of climate-related risks into that risk management function. Part of it is also how are you managing those climate-related risks? So 1, how are they identified, assessed, and now you're looking at how are they managed. So when we identify these climate-related risks, what is the plan to mitigate, transfer, accept, or control those risks? If you have facilities in California and you have a physical risk of a wildfire, what would that mean for your operations? How would you mitigate that risk? What does that mean for your insurance costs? What could that do to maybe your product or maybe a stakeholder group? So thinking about those things and how you can include them in your risk management function. And then last but not least, we have the fourth component of the TCFD framework, which is metrics and targets. So this includes disclosing metrics and targets used to assess and manage these risks and opportunities. When you think about that first bullet point, metrics used by the organization to assess these risks and opportunities within strategy and risk management. So examples of this would be if you are tracking metrics related to water, energy, land use, waste management. Those would be examples of metrics that you could disclose to, note these are areas of, climate concern. Other areas would include those greenhouse gas emissions. Again, this was a reprieve by CARB. This is not required to meet those minimum reporting requirements for this first year of reporting. But if you do have them, please do. CARB has encouraged them to be included. And I do want to echo something that Debbie mentioned. A lot of folks are really set on scope 1 and scope 2 because they know that is required for SB 253 in 2026. But scope 3 is big, it is a lot, it's 15 categories. So it is something that is beneficial to think about earlier on versus waiting. All right, and this is my favorite slide, I think, for the TCFD framework. So I feel like this graphic really shows how everything comes together from a financial impact perspective. So we can see those climate-related risks on the left-hand side. This includes that physical and transition risk that I talked about. And then we have those climate-related opportunities that I lightly touched on the right-hand side. So you can see how these risks and opportunities are inputs into strategic planning, are inputs into risk management, and then are assessed for actual financial impact. So the financial impacts are described in those three main buckets at the bottom of the slide. You have your income statement, you have your cash flow statement, and you have your balance sheet. So you can see how this climate-related financial risk report for SB 261 is really identifying your risk, looking at your governance, looking at your strategy, looking at your risk management, disclosing your metrics and targets, and being like, what is the financial impact based on this information? And that intent of that final deliverable, which needs to be published by January 1st of 2026, is to provide stakeholders more transparency into the risks that could, impact your organization. And with that, I'll pass it over to Debbie.
Thanks, Maddie. Okay, so we are going to move on now to SB 219. So you may have heard of it and you're wondering what it is. So SB 219 is sort of adjustments and clarification. So it's amendments to SB 253 and 261. So I'm going to go through the detail of these. Some of this is repetitive, so I'm not going to go into everything, but I think it is a good reminder of sort of some of the key pieces that we've been talking about. The couple of pieces I want to highlight: flexible disclosure. So 219 did allow consolidated reporting at the parent level for both of these bills. Now there is still an important thing that is outstanding, and we've had a number of questions on it, and I wish I had the answer for you, but I don't just yet, which is, well, what, Debbie, does it mean if we've got sort of an international company and our head office is somewhere else outside of the US, and how does that apply? We do not have clarification yet. That is a known area that CARB is working on, so unfortunately that is still a watch this space. But within the US, you are allowed to do parent-level reporting. The other pieces I just wanted to mention, there is going to be a fee structure, so just keep an eye on that. It's not sort of significantly large, but sort of that will be being confirmed in terms of sort of fee to file. But the good faith methods consideration I'd mentioned before. So CARB has come out and sort of said, well, what does good faith mean, and when are we going to sort of be sort of more gentle with our enforcement? So they came out and they said, to be considered in good faith, company must do the three things: use the greenhouse gas accounting protocol, obtain limited assurance, and pay the filing fee. So those are the three things that they have come out with. As I mentioned before, estimation is an allowable approach where actual data is not available, so that may be something that you need to think through as an organization. Actual data obviously is always better and easier, but it is sort of an option. Okay, so what does it mean to do business in California? Again, sort of this is something that is still being worked through. So the current guidance that we have got from CARB is initially aligning with sort of the tax laws in California. So number one, an entity is actively engaging in any transaction for the purpose of financial or pecuniary gain or profits. That's a really, really broad concept, right? But then they're saying not only that, and any of the following conditions are met. So your entities organized or domiciled in California, their sales in California are above sort of this inflationary adjusted threshold, which is 735,000, which is in sort of, might be sort of something that people look at. So maybe that sort of scopes us out. But then we've got personal and real estate property above 73,000 or 25% of the assets, or payroll above 73 or 25% of the assets. So those two are very, very low from a California perspective. So sort of then that brings sort of that benchmark sort of back down. CARB is seeking input from stakeholders on this. They also did come out in sort of their last workshop and said that they were actually also considering looking at publicly available databases where they can come up with, well, who do they think are the companies that should be complying with the regulation? And they did say they are going to be issuing that in coming weeks. However, that is not going to sort of take away the emphasis from the individual company of determining whether you need to comply or not. So while I think that's kind of helpful guidance and it sort of drives us in a direction, as an organization, you still need to be sort of like really monitoring, do you comply or not, do you need to comply or not, whether or not you're on these lists that sort of come out. So one of the lists they used as an example is the California Secretary of State Business Entity Database, which is publicly available. And they are now estimating 4,200 companies are going to be in scope, which, is a decrease from sort of the 10,000s that we heard about sort of when we initially had sort of had the bills issued. Reminder on exemptions, nonprofits are included in sort of that proposed exemptions that Maddie had mentioned before. I did see a question of that, so I did want to mention that one more time. Okay, so recent updates. Again, we've talked about a number of these, so I'm just putting them on here sort of as a reminder while you're sort of taking a quick read over there in terms of timelines that we've got currently. CARB is currently accepting comments on their most recent proposals within their August workshop until September 11th. So if you want to get involved, you want to submit comments, there is still time. Then we are expecting a notice of proposed rulemaking on October 14th. So if you are a nonprofit and you're like, do I need to comply, do I not? It's proposed, I'm an exemption. If you haven't done anything yet, you might want to wait for that October 14th date to see sort of where you're landing, because that's coming up pretty quickly. And then final regulations towards the end of the year, as Maddie had mentioned. We've got up here so the exemptions that we talked through before, but you can see these written down, and then some of the other sort of data facts that we talked through sort of earlier on sort of in the session. All right, so I am going to sort of pass us on to our final polling questions to make sure that we get through sort of all of those. So Emily, do you want to take us through the question?
All right, thank you. Our final question, SB 219 primarily focuses on which of the following? And your options are A, introducing new disclosure topics, B, repealing SB 253 and SB 261, C, adjusting implementation timelines and providing clarification, or D, replacing CARB with a federal agency. Once you have completed all CPE requirements, you will be able to download a PDF of your CPE certificate from the CPE progress window. So we'll give everyone one final moment on this last polling question.
Thank you, Emily. And thank you for all the fantastic questions coming in. Just very quickly on one, asking which functional department from an organization should lead this adoption and reporting. There is not one right answer. And so as we look across the companies that we work with and support, it really depends on your structure. If you have an ESG or sustainability team, if you have current voluntary reporting, then they are going to be very, very active in this process. But we are seeing more and more finance departments, accounting departments playing an important role. From a couple of reasons, but sort of the main one being they really understand what it means to have well-controlled reporting that is subject to regulation. And so they may not be the sustainability specialists or experts, but they certainly know how to run a reporting process. That's a really important skill set to pull into the conversation. So not one right answer. It can be various different places, but it really does depend on your structure and who has the appropriate skill set.
All right, thank you.
All right, Emily.
And let's take a look at the results. Back to you.
All right, thanks, Emily. And the audience, is spot on with adjusting implementation timeliness and providing clarification for SB 219. All right, so before jumping into how can Baker Tilly assist, I do want to touch on one of the questions is what role can internal audit play as of today? I think this is a question that's near and dear to both Debbie and my heart. Internal audit, internal controls over this environmental climate related data can play a really big role, right? These are laws, there are heavy penalty fees involved. So the sooner you can get, these climate bills and the requirements included and these risks included in your internal audit universe and understand how you can include that in your annual internal audit plan, internal controls over this data will be extremely important for the near term and the long term. I think that for more mature organizations that I have worked with, these type of data, whether it's greenhouse gas emissions, whether it's climate related physical or transition risk, are risks that are included in their internal audit universe. And they do audit this type of data, whether that's making sure it's complete and accurate, whether that's making sure that they're understanding where that data is published publicly to avoid greenwashing risk. So the internal audit function can play a very large role in both of these bills. All right, so jumping back into how can Baker Tilly assist. So to wrap up today's sessions, we do want to highlight how our team can support your efforts. We offer a range of services, including scoping and applicability assessments of your carbon footprint, as well as readiness assessments for greenhouse gas emissions. So this is a really popular engagement that we currently have right now. Let's say you've never calculated your greenhouse gas emissions, we can support you there. But let's say you have calculated it, but you're a little nervous about limited assurance in 2026. So this readiness assessment is essentially a gap analysis where we can look over recommendations, identify gaps, recalculate some of those calculations and strengthen your overall carbon footprint so you feel really confident going into that 2026 assurance requirement. Additionally, from an advisory perspective, we can help navigate frameworks like the Greenhouse Gas Protocol, the TCFD to develop those final reports by January 1st of 2026. And then we have a great ESG assurance team. They can provide that independent third-party reviews of greenhouse gas emissions and general ESG KPIs and support that limited assurance requirement for SB 253 in 2026. All right, and then we wanted to leave you with this slide, a very brief slide, is one, if you haven't started, please start now. SB 261 is quickly approaching SB 253. If you haven't started calculating your Scope 1 and Scope 2 greenhouse gas emissions, I recommend that you do. I think that there is a lot of, if this is something new for your organization, there can be unanticipated roadblocks that you might hit, hurdles that weren't expected. Aggregating this data for the first time can be a large task. So I think starting now, given these really upcoming deadlines, is our main point from this slide. But two, identify areas where your team requires support to meet these reporting requirements. Understand who's going to be the lead. If you need that external consultant support, understand where that area may be, engage them early on, engage them now. And then three, as we all know, CARB is still really in the works of these two bills. So stay informed on CARB's consultation sessions and their outcomes. CARB just yesterday, on September 2nd, released a draft regulation, released a draft checklist for SB 261 that really goes over those minimum reporting requirements. So if you haven't seen that checklist, that just came out yesterday. So I think continuing to stay informed and on top of CARB's newest and greatest, recent updates is going to be really important over these next couple of months to make sure you feel really comfortable and prepared for SB 261 as well as SB 253. And with that, thank you so much for joining us today. I know we didn't get to every single Q&A. We will respond over email. There were a lot, and we really do appreciate the interaction, and we will get back to you on those. But with that, I will pass it back to Emily to close us out.
All right. Thank you, Madison and Debbie, for a great presentation today. As Madison mentioned, if we didn't have time to answer your questions, we'll do our best to follow up with you after the webcast. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 2 to 3 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.